afternoon, everybody. My name's Paul Harris from Mining Journal and Mining Stock Daily, and I'll be moderating this panel. We're talking about behavioral biases and navigating the promotional side of investing in junior mining. I'm joined by Claude Bejet and Luc ten Have. Let's start off with an easy question for you guys. Who are you and what do you do?
Well, basically, I'm like most of the people here in Frankfurt. I'm a private investor. My background is I majored from the Paris Business School. I also majored in philosophy, sociology, and psychology. It's the last thing that's the most useful for us.
Thank you.
And I've been speculating in the market since '87. That's basically what I've been doing. So few people just have that as source of revenue.
Yeah, my name is Luc ten Have. I'm not here for 30 years or something like that. No, I'm here for about 11 years now in this business. And I'm actually from the oil and gas industry. And a couple of years ago decided to spend all my time on this industry as an investor. And since a year also through a platform called golddiscovery.com. And so I am busy every day with this business.
Well, thank you. I think we've got a range of perspectives on this panel. We've got the older and oldest, or the younger and youngest.
I'd prefer to be on the other side.
So we've got a lot of different perspectives here. But let's start with Claude's observation or comments about behavioural analysis. Successful investors define strategies which are in line with their own psychology and their own behaviour. We all have different levels of risk aversion. If we like value, we buy value stocks. If we're momentum buyers, we perhaps buy momentum stocks or have more of a trading pattern. Claude, tell us more sort of about this, and can you give some investment examples that illustrate the sort of behavioural point of view?
Yeah, sure. I attend a lot of conferences, and at conferences you always have some very good speakers with fantastic track record, wonderful fund managers, and then we want to know what they're buying, what's interesting to buy, and then they don't answer the question. They say, oh, it depends on your individual aversion to risk. And I'm there, and I'm sitting like you are here, and I'm frustrated. I mean, okay, they don't want to take a risk, they don't want to appear like a fool, but you know, they should know that, you know, we can be right, we can be wrong. So what I think is important is that, you see, we as individual investors, we have to find an edge on the market. Because if we have no edge, how can we compete with Goldman Sachs, with JP Morgan, who are often rigging the price, as we all know? So we have to find an edge. And the easiest edge, and that's what's made me the most money over the last decades, and also lost the most money, is the psychological bias. So when you're going into a strategy, you have to think it out in terms of your own psychology. So for example, I'm born after the Second World War, so things were difficult and we were buying cheap. I like to buy cheap. So I'm comfortable today because everything's cheap. So buying today is easy for me in the market because it fits my psychology. I try to find real value, and that's what I do. Maybe an example, Springpole, Ontario. When the market is frothy, when everybody's happy, then you know, it's a great deposit, 5 million ounces and so on. When it's at 5 cents, then, it will never be a discovery. 4 companies have worked on it. It'll never be something doable. And then Quinton Henning comes up and you have a 10-bagger. I had one 10-bagger thanks to Quinton. Stock collapses in 2008. I buy it back at 5 cents. And at that time, people tell me, oh, it's under a lake. Nobody can build anything under a lake. And then the market gets better. 2011, you have another 10-bagger. Today, you can buy the same deposit, Springpole, which is now in another company called First Mining Gold. And since the market is not too good yet, They'll tell you, oh, they'll never get a permit, they're in Ontario. Oh, okay, we'll see. So I hope I have another 10-bagger. Maybe you can have a look at First Mining Gold. It's very, very cheap.
Thank you, Claude. Luke, same question to you. Obviously, well, you've got a very sort of technical approach to looking at stocks. So presumably part of that is to take away emotional aspects, to take away behavioral aspects in decision making.
Yeah, I fully agree. What I like most in investing in these juniors is to buy the things that nobody wants to buy anymore for understandable reasons, because there are many stocks trading at 2 or 3 cents, and not all of them are an opportunity. But some of them, it's interesting to find out why did they go from $2 to 5 cents. And sometimes, for example, the situation in the country changed, or sometimes the essays were just showing that it was not there. They were expecting something to be there, but it was not there. And often it takes a year or 2 years until that price goes from $2 to 5 cents. And you can really see that slowly but surely there's no seller left, because everybody who wanted to get out is out. And at some point, if there's no seller left, then you can still accumulate over a long period of time some stock. And you often see it flatline for sometimes weeks, sometimes months, sometimes a year even. But you get a good feel for, okay, the selling is over. If you then get in contact with that company and you find out, what are your plans? Are you going to drill it again, or are you going to look for something new? You get a sense of what they are thinking of. And if that plan makes sense to you, buying it at 5 cents may be a very good opportunity. But in 8 out of 10 times it may not. But if you find that one where it's interesting, you can really make a 5-bagger without any drill news, without anything. Maybe a project acquisition or anything else. So I really look for those distressed stories and find out, why are they distressed? Is it for a good reason? Maybe yes, right now, but could that be solved in 2 years? Or could they fix it somehow? And I think there are many companies around there where you can at least make a 3 to 5 bagger just by understanding that the opportunity will present itself again. But you need to sort of imagine, where can this company be in a year or 2 from now if they execute on what they are planning right now? And then I had it quite often that that company just gets back to life. Sometimes it takes a year and just goes to 20, 30 cents again before even announcing any new real news. So sometimes it's just because the market forgot about it. Everybody's sold. You go to a chat board, nobody talks about it anymore. And I'm not saying it will always work, but if you do your work on it, this is a real opportunity, I think, in this business.
Thank you, Luke. Now let's build on that. You know, identifying opportunities is part of the challenge. But then once you've identified an opportunity, what are some of the triggers for a decision to invest? How important is price valuation? Obviously, with pre-revenue companies, often pre-resource companies, it can be very difficult to put a valuation onto an asset and what the company's worth and potentially where it's going to go to. I can name half a dozen advanced stage junior gold developers in North America with multi-million ounce deposits. How do I choose between them? To what extent the share price or market capitalization a proxy for valuation?
Well, first of all, maybe one comment on price. And if there's any CEOs in the room, they have to understand that the number one proof of quality for the average investor, including institutions, is the price. If the price is high, it's been going up, everybody assumes it's a great company. It's not necessarily the case, as we all know. And then when stocks are at 5 cents and you're picking them up, then most people will say, oh, this company is not worth anything. That's the psychology, that's the perception. So you have to sort of balance this with a reasonable, method to value things. So it is, of course, much easier if you have development companies. Then it's easier to value because you already have a 43-101 with 1 million, 2 million, 5 million ounces or whatever, or even high grade at 500,000 ounces. So then you can start and toy around with value. So then that's what you're trying to find, is a huge gap between the net present value of the project and the current share price. One example you can look at today is Westvolt. As Luke says, if nobody talks about it, it's already a good sign. They have the perfect project. It's in Nevada. They have the best shareholder base in the world, and they have a permit. Nobody has permits. The NPV is very high. The market cap is $50 million. So here there's a gap. Now you have to understand, why is there this gap? Now there's a big problem with this company, is that the chairman, Peter Palmetto, who's one of the best money managers around, he does not want to go into production until gold's at 2,500. So nobody's buying this stock in the institutions because there's going to be no news until gold is much higher. Now, will all these managers outperform Westvolt? I'm not that sure.
Luke, same question?
Yeah, so similar example. I mean, I will go with an example too then.
Yeah, we want to buy stocks because it's buying time.
Exactly. Now, this case was recently, and it gives a little bit of an example of what I just said. So a couple of weeks ago, there was a company called Satori Resources, I think, or Minerals, and they have been working on a property in Manitoba for a long time. And they have, I think, delineated about 300,000 ounces at 7 grams, but nobody was interested. It was always trading at 10 cents or 5 cents and a market cap of 4 million. And then I see that news in the morning where Rob McEwen is buying, I think, 35% of the company and vending his company into Satori. If you look at a company that's worth 4 million, they have high grade, but maybe it's small, but high grade. And Rob McEwen, with a history of turning small high grade projects into big projects, steps in. You know one thing for sure, the cost of capital, which is probably the most important thing in the mining business for small companies, will suddenly drop, because with him, all the connections come, the money comes, and this company had difficulty raising money over the last couple of years. And when Rob comes in, and some people may feel like, oh, Rob didn't perform well with Rob McEwen Mining the last couple of years, he's still a very smart investor in this business, has been around for 30 years, has built Red Lake and Canadian Gold Corp to what it is right now, until it was taken over. So he's stepping in a 4 million junior. For me, it was just a very easy decision. Immediately, I bought all the stock available at 7 cents, because it will change the story. And right now, a month later, it trades at 30 cents. It's a very easy trade, because you know that a company like this, he's not just stepping in for a small, short trade of 2 weeks. He's going to try to make it work. And he cannot make it work at 4 cents. So he will put his capital to work, get his friends in, get some money in. And so you can see that just one new person, nothing changed to the gold mine, nothing changed to the jurisdiction, nothing changed to anything. There's just a new investor, and psychology changes. Everybody wants to own it again. And this shows that behavioral model really works. Just understand, when will investors like it again? And that's right now.
Yeah, since we were talking about behavioral psychology, I mean, one of the easy way to make money, I mean, easy, nothing's ever easy, but is to follow the leader. So if you have some fantastic money managers like Ross Beatty or Frank Giustra, and you know, there's a company under their belt which is trading at very low valuation, then you step in. So that's one of the examples that you can see here at this conference is Black Wolf, copper, and gold. There's 3 ways this thing is going to re-rate. It's you're paying maybe 50% more than what Frank Giustra paid, so you're not overpaying. And they have a hub and spoke model. They're working on that. They could consolidate maybe the whole district. They have a great exploration grounds in Alaska that can be huge, and you're backstopped by 770,000 ounces of high grade, which basically, you know, backstops your current valuation. So you have low downside and huge upside.
Thank you, guys. Obviously, betting on the jockeys is one strategy. As you say, betting on successful people that have a higher probability of future success, because they can attract better projects, they can attract lower cost of capital, and they can attract better technical teams to run and develop the projects. But obviously, it's not always possible to get in early, or at the first stage or the second stage. But to what extent people need a price reaction to become confident in an investment opportunity. I'm thinking here, you look at companies like Philo Mining or more recently Collective Mining. They moved very strongly, but then they've kept moving higher and higher. So is there still potential to come into such stocks and to give people the confidence to sort of, leap even once a stock has moved? Is there a wisdom of the crowd there, or conversely, is there a quality trap?
Again, I'm coming back to my former statement. Since I'm a value guy, momentum is not my way to do things. So if you're really good in momentum, and if it's your psychology, then you might ride these end of waves, which can be extremely rapid. But of course, the higher it goes, the more everybody tells you it's quality, then there's more risk and probably much less potential. Aya Gold is a fantastic company. They're in Morocco, but the price has already risen by 100 times. So, can it rise still? Yes, it can. But
Yeah, I would like to add to this is, I think there are two questions hidden there. So one is, do you need price actions to react? And I think a lot of investors want to see price action to get confident. And I think, that's a way to do it, because then you see, the market is picking up, so I should maybe pick up as well. But if you look at these really tiny juniors, like below 50 million, they can just go so rapidly. And then suddenly you pay 20% more. If that's on a real discovery, for example, I don't have any problem to also buy in and maybe even pay 50% more than the previous price, because you have the confidence of some new data that tells you, hey, there's a real discovery here. But what if you just know a company and you understand the quality and you just don't know when it will happen, but you're pretty convinced that it will happen, that the company will succeed again? Then I would rather just be the first one and just have a lot of patience, because often you can buy these things at really ridiculous prices, but you need to have patience. It can take half a year, it can take a year, and it will just be a dead stock. Your money will be illiquid. You will not have access to your money because it's kind of impossible to get it out. Especially in September last year, I was bidding on some stocks, and there was no bid at all. I was the only bidder. And if somebody sells into my bid, nobody's going to buy it from me in the coming weeks or months, because there was a lot of concern about the markets. But if you are convinced about your own work, then I think that makes sense. If you're looking for discovery, and a real discovery hole is announced like in NGEX recently, then I don't mind paying more. So see it go up in the morning and try to be the first buyer in the morning, if you believe that could be that big discovery hole that everybody is looking for. And then I think it's okay to pay a bit more. I would not go in between, where a company already tripled without real news, anticipation, and then hoping for that real result, that real assay result to back it up. Then you're taking a big risk. So I would either go for, question answered, discovery, jump in, or be much earlier before anyone talks about it. Because anything in between, you pay for a stock that already moved up 2 or 3 or 4 times, maybe without real reasons. And then you're taking more risks, in my opinion.
Yeah, to add on what Luc just said, if you're buying cheap enough, timing does not matter.
Yeah, you don't want to be chasing higher. Okay, let's take a different viewpoint now. Let's have a quick show of hands, if I may. Do you guys find your investments through your own work, or do you find investments through recommendations from third parties, newsletter writers? People who find investments through their own work, hands up. And from newsletter writers and things like that. Okay, a bit of both. Okay, so as Claude mentioned, everybody wants an information edge to trade on. We tend to value our own knowledge or what we've found out higher or more so than sort of general information. CEO.ca really thrives on this. The chat board's there, and this is the foundation of the service offered by a lot of newsletter writers. It's their business model. We're at, people will say, we spoke to a CEO at Deutsche Goldmesse and he told me ABC, this is good, actionable, tradable information. How should investors handle the information they get in these calls or these meetings from the CEOs? Is it really to be trusted? Should they really trust the insights that third-party newsletter writers provide for them? How should they handle that information? Who
Yeah.
wants to go first?
Let me. First of all,
Mining Journal's great, of course. You can trust and rely on everything I write, but here we go.
no, I think it's not a bad thing to follow newsletter writers, especially the ones that you trust and you have good experiences with. I mean, Brent Cook and Joe Mazumdar are, I think, always seen as very good ones, and there are plenty good. Everybody has his own strategy a little bit, but so there's nothing wrong with it. And they give you ideas. You can read why they think it makes sense. But the danger is a little bit, in my opinion, that you would buy it just because they say it, or you would buy it because they say it and you just scroll through the corporate presentation and think, oh, this makes sense, let's buy it. And then if something goes wrong 5 weeks later, you wonder, why did I buy it again? Oh, let's go back to that analysis. So I think it's easier or better that you really spend a lot of time on it, think about it, like what could go wrong, what could go right, what are the chances, what will I do if it goes wrong, and what will I do if it goes right? And are there any, I mean, I'm not sure how often these people talk about 4-month hold periods, because often after financing, after 4 months, you just see a big selling wave. Can you deal with that selling wave, or you want to get out beforehand? So I think a lot of people just get in without completely informing themselves and having a complete plan, like when am I going to sell? And if you don't really have that, and you just follow the newsletter writer, I don't think that's enough. If you use the newsletter writer to find a story, let them explain you why, then I think you still have to build your own idea around it. Otherwise, it's still risky.
Thank you, Luca. I just want to add to that. When you build your spreadsheets of what you've bought, the price and the date, also add in a column of why I bought it. What was the thing that triggered you to buy it or made you say, I'm going to put some money into this? So you can remember that 3 months, 6 months, 12 months down the line when you say, what on earth is this doing in my portfolio? Claude, your opinion on this, please.
Look, I spend a lot of money buying newsletters, buying all sources of information. And as private investors, we have a huge advantage on institutions because they only have their own research. We can go everywhere. And we can talk out to CEOs. We can see what newsletter writers tell. We can check things with geologists that we might know. I think it's a difficult game, and we have to gather as much information as possible. Now, having said that, Luke's point is extremely important. If you don't do your homework, at least a little, you will never get your own conviction. If you do not have a strong conviction, you're going to sell at the wrong time and you're going to buy at the wrong time. So I would do a mix of outside information because, you know, I'm based in Lausanne, in Switzerland. If I stay sitting at my desk there, I have a very nice view on the lake, but that's not going to find me a good stock. So I'm going to be speaking with Luke after this conference, and, you know, what's your best idea? And then I check it. If I like it, I have my conviction, and he's done a lot of the work. He's filtered. You know, that's how I do it.
But even if you don't buy somebody's idea, knowing people helps a lot as well. Just talking to people. Because indeed you can call someone because you think, hey, he may know a little bit more about this type of project. So not only, I mean, meeting companies is perfect. I mean, you get an idea of their project and their company, and you may even buy it, but also getting to know them and talk to them in 6 months again and see if they still have the same story. Write down what they say right now and check in 6 months if they accomplished or still working on it. I think meetings always help, whether it is with the companies, whether it is with other investors, whether it is videos online. I think the more you understand about the market and the deals and the financings and anything that happens that has an influence on the market, the more you know, the easier it gets to actually make money in the business. And I think a lot of people lose money.
Okay, I think to follow up on that, I think it's really worth attending events like this where you can meet experts and the companies, because the public information is so limited in what it can say. And often the critical things or the catalysts are the nuances which CEOs cannot really openly say in public. So having an understanding of that. And also to Luke's point, finding out more from people that are more expert in certain things or certain jurisdictions. For example, here at this conference, one of the attendees came up to me to ask me about Colombia. I'm based in Colombia, I live in Colombia for 15 years, so I can perhaps provide a deeper level of insight about what's going on politically and regarding the mining sector, which may or may not be relevant to that person's investment thesis for that country. Now, if buying a stock can be a tough decision, selling is perhaps more so, both to the upside and to the downside. When our stocks go down, we all have the hope they will recover and perhaps hang on too long and don't sell when we should to cut our losses and run. We have an aversion to take a loss. We lack the sang-froid to cut our losses. Likewise, when stocks go up, when's the moment to take your money off the table, to bank the profits? We always expect them, it's gone up 100%, it's going to go up another 10, 20, 30, 40% as well. Maybe we get greedy. Maybe we're right to, maybe we're not. What are our panelists' views on that? Selling stocks. When's the right time to do it? What should be the front of mind when you're coming to sell a stock?
I'm going to insist on the easy part is the buying part, okay? You're at the conference, they're Silver X, they're doing a placement. The production is 2 million ounces. Their market cap is $65 million. They have acquired a huge deposit, high grade, Orcana for nothing, okay? So you're buying it for nothing. They're producing 2 million ounces. With a little luck and a lot of hard work, they could be producing 10 million ounces. You know you're not going to lose money with this. Now, when to sell that is going to be a much harder decision.
And that's the question, Claude.
And I don't have the answer. So I tend to keep my stocks for the long term. So if I do a placement, then I'll do a second placement. I'm going to keep the shares, keep the warrants. I'll do a second placement. If that works, keep the shares, keep the warrant, and I'll do it a third time. So if I'm lucky. So what happens is that a lot of stocks, they'll double, but then I won't get out and I'm going to go back down. But if I have a 10-bagger on my on the positions I've built over time, then it compensates us for a lot of losses. So I don't have a really good answer for the selling part. It's more difficult. I also expect we're going to have silly season again in the junior gold space. I think we've broken out to the upside in January for the small cap. So now we're in a bull market. I think it can become crazy. So then we could be in a position where we're going to go exponential, like in the 70s and 80s. So then probably I'll sell too early.
Yeah, selling is for sure way more difficult. But I think it's not possible. But the easiest way would be to completely shut down your emotions, because if you don't care, if you can sell, for example, just say you bought something at 10 cents and it's at 30 cents, but you think, oh, it may go to $1 because if this happens, then it may be. You always struggle with that. And I think at some point you need to make a decision and also accept that decision, whatever happens. And it's extremely difficult, but a real example, company here is Delta. I know them for years. They did a good job at 40 cents, then they did a financing, and after 4 months, the investors sold everything. So the stock went to 6 cents. I liked it at 40 cents, and it was at 6 cents. So I started buying at 6 cents, and not a couple of months later, they announced the discovery, and now Delta is the big story of the day and trading at 50 cents, I think. At 35 cents, I sold. And this stock could go to $1 or $2, actually, I think, if the next holes also show what they are. So is that a bad decision? I don't think so. I was expecting this 4-month hold to come off, the stock to go down. Didn't happen. I still think I made a profit. If the next holes are going to be good, I'm probably going to go back in again. You can only do it if you just accept your emotions, because I don't like it. I would rather have everything still. But at some point, you just have to lock in gains, because if you never do it, you will not make money. So I made money so far. I will judge if the next news releases are as good or better than the last ones. And then I may buy back in. Even though that doesn't feel good, I think you have to do it. So emotions down and decisions to be made. That's, I think, what you should try to do, even though it's way easier to say than do it.
So be happy you made a profit. When you buy a stock, do you have a projection of, okay, I want this stock to get there, and that's potentially my exit point?
I'm not smart enough for that.
I have something in mind, because you have a theory about you invest for a certain reason. And what if all these reasons happen in a row? It could go, of course, always 10 times. But you're not going to take that, I think, example unless you really want to hold on for a year or 2, or 3 even sometimes. But I think it's good to have a short-term target and a long-term target. And after a short-term target, you think the risk will become greater right now, you could sell 50% and hold the rest. So I think I always have a bit of an idea. And sometimes that shifts if things are just going well, and if I see more risk, then I think it's time to sell at least something. But a little bit of a target in your mind is, I think, an important thing, in my opinion.
And I think given we're talking about behavioral aspects, I think it's always important to recalibrate your expectations over time, because a story changes over time. A discovery hole can completely change the exploration story, enlarging the size, so that the potential selling point could be that much higher or that much bigger. Conversely, bad results could really shrink the story. And so your expectations of this could be a 10-bagger or a 5-bagger could go up to being a 20-bagger, or it could just cut in half and, time to get out.
Yeah, absolutely.
That happens a lot.
Yeah, and it comes back to the main point. It's what is your psychology? If you're very risk adverse, a lot of people I know who are very successful, if their stock doubles, they take half the money off the table, they got a free ride. There's less emotion, and it works very well. For me, I let my profit run, I'm on another system. But you see, so you have to find what works with you and what can sort of mitigate risk and increase your upside.
But selling is difficult, that's for sure.
Okay, well, we've run out of time, unfortunately. I'm sure we could go on for another 30 minutes or 60 minutes. But please join me in thanking Luc ten Have and Claude Bejet.
Thanks, Aris.